Right, and that's been a positive sign for the stock market, too, despite a lot of these recent hiccups. Well, the 10-year yield is hitting its highest level today since the end of July after this morning's hotter-than-expected CPI print. But our next guest still believes yields are coming down, so good news for Mike's B of A trade there, potentially. Michael Schumacher is the head of macro strategy at Wells Fargo Securities. So I was talking to Brian Weinstein, a colleague of yours earlier in the week, who thinks the upper end of the 10-year range could be 5.5% in the next year or so. That's out of consensus for sure. Katie Stockton is one who thinks that, maybe we're going back into the high threes on the 10-year. Where do you fall?
I'd say probably low to mid threes, Kelly. So by the end of this year, call it 3.75. Next year, 3.25-ish. But it all hinges on the Fed. If the Fed signals, hey, we're likely to cut fairly aggressively. None of this nonsense about skipping a meeting. That's pretty silly. Yields are going to come down a fair bit. So I think it's been a lot of this talk from the Fed. It's actually pushed up rates, both on the front end, also the back end.
Dan?
Yeah, how restrictive do you think the policy is right now? So again, we have GDP that's tracking ahead of trend in 2024. We have unemployment that, I guess the Fed indicated 4.4% by the end of the year. That might not happen here. So when you think about where yields are, where you think they're going to go, is it partially because of the rate and where it is as being restrictive, and they're worried about obviously sending the unemployment rate higher and the economy lower?
Policy is restrictive. Think about what the market's telling us regarding the end of the Fed cycle, the terminal rates, 335, 340. That's a big number. The Fed itself would tell you neutral is about 290, 285, something like that. This is quite high in the beginning stages of an easing cycle. Things are not that great, frankly. That's why the Fed's cutting. And for the market to sit there at 335, 340 is simply too high. Policy's too tight.
Julie, you want to get in here?
Yeah, what I'm curious about is, a little bit piggybacking off of what Dan said, what should our expectations for economic growth really be if we assume that, higher rates really didn't hamstring the economy the way I think people expected? Should we really expect it to reflate dramatically on the downside?
Shouldn't really expect a recession necessarily, but things could tip that way. So if you think about the probability, let's say, of hard landing, soft landing, maybe hard landings 25%, 30%, something like that. So it's not a given that we're going to get a soft landing. The Fed's looking pretty good right now, but there still is not quite the buffer the Fed officials would like you to hear and think about. So they want to see a bit more room before they get too excited and take that victory lap.
Michael, how do you balance the volatility, though? The VIX is elevated, and that can be for a lot of different, there can be distortions there. I know you at least throw out the possibility of tail risk around the election, and certainly a result that's not clear. Help us understand whether you think markets overall are positioned for that, and is the VIX telling us something that maybe we don't see?
Yeah, markets are not ready for that. The rate market is telling you, look, vol is going to be high for a fair amount of time around the election, and people like to try and home in on one day, but we don't all vote on one day anymore. It's not the way things work. So what's the chance we'll actually know who the next president's going to be the night of November 5th? Probably pretty low. And who controls the Senate? Also low. So I think you've got to prep for a period of extended volatility. If it's just a day or two where we're left hanging, not such a huge deal. But if that stretches out to be a week, I think that's a pretty major risk-off event. Yeah. S&P's down, who knows, 2, 3, 4%. Bond yields go down a lot. That's when my call's looking better, frankly, Kelly. So I wouldn't mind seeing some of that, but maybe for the wrong reason.
So you'd be a buyer of treasuries here across the curve, really?
I would not take a ton of risk, but I'd want to be long at least a bit. So, and preferably more toward the short end of the curve. Keep that duration relatively low. And if it all hinges on the Fed, why not focus on the part of the curve that's most impacted by the Fed?
The very short
2-year, 3-year front end. That's right.
But then you'd have to, then you think they are going to be cutting pretty significantly.
I do. I think this talk about skipping a meeting makes no sense. You can't go 50 basis points on September 18th and say, well, we kind of misread the data. The data are puzzling. We're not sure what to do. We'll just wait. That's just not a good message to send.